But if you're like some of us and you have more credit card debt or consumer debt, and you're interested to hear how your 3% or below 30-year fixed rate might be holding you back, do tune into this part because it's pretty fascinating. So let's just talk about the economic landscape for consumers right now. Personal savings is at an all-time high. So if you see that gray bar in the top box there, that is the pandemic. That was the recession that we went through during the pandemic. And if you look right after that, we have a big spike in consumer savings. People were getting supplement money from the government for the pandemic. We were not allowed to travel. We couldn't eat out very easily. It was harder to spend money during those 2 years we were stuck in our houses. And so Americans were able to pay off a significant amount of debt and put a lot of money in savings. So we had an all-time high for consumer savings at the time. But then if you look at what's happened since there, as inflation went up, starting in 2022, we had a big spike in the cost of everything, the cost of goods and services. And so basically, as you see consumer savings dwindle down to its level in January of 2023, which is where this graph stops. But consumer savings is at an all-time low. And then credit card debt as a byproduct is at an all-time high. We just surpassed $1.2 trillion of credit card debt, which is a massive number as a country. And then people are sitting on large credit card balances with really high interest rates, because every time you hear that the Federal Reserve increased interest rates, they're actually increasing the federal funds rate, which has a direct correlation with your credit card payments. Every time federal funds rate gets increased or spiked by 1/4 or 3/4%, it has the exact increase on your credit card rate. So Americans are finding themselves in more debt than ever with increasing interest rates on their credit cards, and it's becoming a big mound of debt to get out from under. But the good news is that Americans are sitting on a tremendous amount of equity. And so some of the things we're going to talk about tonight is, what can we do with this debt and our equity and still transition to a new home and upgrade to that new home? Lauryn and I are going to show you the path of how you can successfully do it with the equity you have in your home. Okay, so I hear, as a mortgage lender, I hear so often people that want to make a move or they want to access equity in their home, but they are really, really fixated on this amazing interest rate that they secured during the pandemic. During the pandemic, from 2020 to the beginning of 2022, we had record low rates, the lowest I've ever seen in my entire career. So rates got as low as into the 2s. I love how people brag to me like, I have a rate of 2.625, and it is one that would be hard to part with, but at what cost is what I would ask you. So this is actually this is a client of mine. What she owes on her house is $475,000. Her interest rate is 3.75, and her total PITI payment, principal, interest, tax, insurance, is $28.19. And Jane is her name, that's what we'll call her, wants to make a move. She's ready to transition to a different home. She needs more space. Her family is expanding, and she's trying to figure out what to do. So I meet with Jane. We do a consultative pre-approval appointment, and part of that pre-approval appointment is doing an analysis of what Jane qualifies for, and that includes looking at what Jane's liabilities are. What does she have on her credit report that I have to consider in her overall qualification? Jane has 4 big credit cards, and these are Jane, they just got into some debt as a family, going through, again, inflation and the cost of goods and services going up. They just ended up supplementing with credit cards as a family. And so Jane's got 4 big credit cards. It's a little over $80,000 worth of debt, which is an extreme example, I would say, but this scales with other families. These are her true interest rates on her credit cards and her true minimum payment that Jane's paying monthly on the 4 credit cards. So when we look at her entire household interest percentage, her blended interest rate, which is her mortgage and her credit cards together, what she's holding in totality, she has a $556,000 outstanding amount of credit that she owes or debt that she owes. Her total monthly payments on her mortgage and those 4 credit cards is $48.33 a month. And her blended interest rate total is 7.066%, which just so happens to be a smidge above where mortgage rates are today. So her blended rate is actually higher than where mortgage rates are. And so it is something that we have to consider as we think about maybe transitioning and helping Jane and her family get out from underneath this debt. The average American per CoreLogic has about $274,000 worth of equity, and that's the majority of Americans' wealth. So we need to look at how can we use Jane's equity to help her transition to a new home and be able to consolidate her debt and not extend them even more as a household. So they're barely getting by at the $48.33 a month. And so Jane would like to accomplish a few things. She'd like to lower her monthly payments. She would like to transition into a new home. And she'd like to hold on to her 3.75% interest rate. So I put together a presentation for Jane to show her exactly what this would look like for Jane to be able to transition to a new home.
Hey, Jess, before I let you share your screen, one thing I'll just point out too, I know that these are just credit cards, but this could easily be swapped out for 2 car loans. Car loans are very high right now. So the $85,000 is not necessarily unrealistic when we look outside of just credit card debt, but home equity lines of credit. I'm working with lots of clients today who are looking to sell, but also have their HELOCs all the way maxed out. So I know that number may sound high to some viewers, but when we look at overall debt and we break it down outside of just credit cards, Americans do have debt. And I think you and I see it intimately because of our job.
Thank you, Lauren. That's a really good point. So I'm going to pull up the presentation that I built for Jane. Jane identified that she wants to be in a different part of Denver. So her move up house isn't too much above what she owns now. So her current home, Lauren could sell her home for $700,000. This is her total payments. So if you look at Jane's current breakdown of her monthly payments, her all-in mortgage payment again is the $2,819. Then she's got the $2,014 a month of non-mortgage debt. That's what comprises her current household output of $48.33 for her payments. If we look at her new home purchase, so she's looking to get into a home that's a little bit more expensive. The home in the area that she wants to be is approaching $800,000. So what Jane and I put together is selling her current home, paying off the credit card payments that she has, that debt, so she can get out from underneath it, putting down the difference of her equity. And then we did a creative interest rate buy down for her just to get her interest rate down a little bit. And her all-in monthly payment is $43.1391. So she's upgrading to a new home that's slightly more expensive in a better area that's closer to her family. And she's saving about $520 a month in total payments. Now, the even cooler thing is, let's say that she was comfortable at $4,800 a month. Yes, it would be nice to save $519, but the other thing that we're all facing is we eventually want to be completely debt-free, right? We want to get 100% out of debt so that we can live mortgage-free and debt-free at some point in our lives. So I also put together for her just what it would look like if she just continued to pay what she's paying now on her $775,000 house. So if she was willing to contribute the $520 a month savings to aggressively pay down her mortgage loan, what would that look like over time? So let's say Jane, we're going to look 15 years out, she's purchased this home and she made that additional $520 a month. If she did not pay that extra $520 a month towards her mortgage, 15 years from now, she would owe about $429,000 on her house. Yes, she'll refinance at some point, I'm sure, but let's just for the sake of looking at the data, let's pretend she didn't. She would owe $429 on her home. If she just simply paid for 15 years, the $520 that she was paying to credit card debt, she's now paying it towards her mortgage. Now her mortgage balance, 15 years, same time cycle, would be $274,673. So she just gained a couple $100,000 worth of additional equity just by making that transition, taking that extra money that she's saving and putting it towards putting herself in a better position for retirement. So overall, just to recap, Jane's upgrading to a new home. She's getting closer to her family. She has more space for her family, and she's able to get out of credit card debt and save more for retirement by paying her house off faster. So Jane's winning overall just through this strategy of being able to use her equity and accomplish all of her goals with the right strategy.
Yeah, I think this is such a powerful example, Jess, of why 3%, 4% rates for mortgages are actually holding many consumers back. And this is the type of strategy that Jess and I love to do, really identifying where the pain points are with our clients, and then diving into the financial situation and the options to help them achieve that freedom again and enjoy their life, enjoy their home, and get rid of that weight that debt is. So it's really a powerful example of the potential of how real estate helps our clients build wealth, and the different strategies that are not mainstream, but can really help achieve a lot of savings.